If you are a bond lover, this might be your time to shine because the bull case for bonds may be back. We're gonna look at this from two different angles. Number one, we've got to look at this from the banking crisis angle. Banks are in trouble. They don't actually have your money. So what is something that you can do instead? The second angle that we're going to look at this from is the inflation to deflation trade, because right now in the bond market, the inflation trade is very crowded, record crowded. And when trades get crowded, it means the consensus is likely wrong. So first up, the banking crisis and what you can do with your money instead. We have to ask the question, what is a bank? Today in the United States, a bank is a place that takes your dollar and then turns around and loans it out to somebody else. That's what every bank does, and they do that with basically all of the money that comes in on deposit, which means they don't have your money, which means if you and all the other depositors go to the bank and ask to get your money out, they don't have it. They have to sell other assets, which are likely at a loss, and they go under. More often than not, they are loaning these dollars to the United States government, an asset that is considered risk-free, that is, unless it's at a loss when you have to sell it. Now, normally you would want to wait until that bond matures until they pay back that debt. And so that's why they say it's risk-free, because the government will never default on its debt, unless, of course, they default. Now, normally they would say it's risk-free because the government will definitely pay that money back, but that's once it matures. That has nothing to do with that bond being at a loss if you have to sell it before it matures. So you take your dollar and give it to the bank. In the meantime, the bank takes that dollar and loans it to the government for the next 10 years. Now, they're going to get 4% on that, and they're going to pay you 0.01%, and they're going to keep the rest as a service for doing that job of holding that dollar safe for you. And if too many people go and ask them for their dollars back, then they'll have to go sell that debt that they just created by loaning it to the government. And if it's worth less than it was when they bought it, well, that means then you lose your dollar because you go down with the ship. So not only are you losing out on all that fancy interest, but you also are taking the risk of what if the bank goes under. This is where a strategy called laddering T-bills would come in. This is not a strategy that in years past has been an attractive strategy, but rates are at the point right now, and banks have enough risk right now where this might be an attractive strategy for some. Right here, you see the daily treasury bill rates, and you can see that for the 4-week, 8-week, 13-week, and 17-week T-bills, the interest rates are fairly attractive. Considering that inflation in March was 5%, means that some of these yields actually are positive when they're adjusted for inflation. This has not been the case for a long time. For years now, the inflation rate has been above the interest rate, meaning that you make 2% on your loan, but you lose, let's say, 7% to inflation. Now inflation and interest rates are at a point right now, kind of at a sweet spot where even when adjusted for inflation, the rates are positive. I'm gonna show you how to do this laddering strategy because this is a strategy that would be a replacement for savings that you don't necessarily need right now and you wouldn't necessarily need all at once. So this is not a strategy to replace your checking account for your daily budget needs, but this is a strategy for maybe an emergency savings account or something similar to that. Let's say you've got $100,000 in your bank account right now, and you want to earn a higher interest rate on that, and you don't want to leave it in the bank because you don't trust the bank. You would take 25 grand and put it in a 4-week T-bill, another 25 grand, put it in the 8-week T-bill, another 25 grand in the 13-week, and the last 25 grand in the 17-week. Now, what you'll notice is then every 4 weeks now, you've got a quarter of your money coming due. It matures, it pays back. This is why I gave the example of the emergency savings account, because usually in an emergency situation, you can wait at least a month before you have to pay something because maybe you can use a credit card. And you know, every month now you've got money that's paying you back for the next 4 months. This is why you wouldn't want to load it all up into the 17-week T-bill, even though it pays the best rate. Because then if push comes to shove, you might have to sell that T-bill at a loss, depending on what interest rates do, and you wouldn't get to just wait until it matures and get that high interest rate paid to you when it does mature. You also wouldn't want to put it all in the 4-week one because then you don't get the advantage of the higher interest rate of the longer term T-bills. So you split it up into quarters across the 4-week, 8-week, 13-week, and 17-week, and that gives you kind of the best of both worlds with the liquidity of a quarter of it coming due every single month, and then getting the higher interest rates. But you're not done yet, because in 4 weeks, the 4-week one will have matured, and there will only be 4 weeks left on this one, and there will only be 4 weeks left on the 8-week, 9 weeks left on the 13, and 13 left on the 17, which means that the money that just matured from your 4-week, you're gonna now purchase a new 17-week. And assuming you don't need the money, every 4 weeks, once that next one matures, you're gonna roll that into a 17-week one. And eventually then, after this happens 4 times, you'll get to the point where every single time you do this, now all of your money is in the 17-week one, earning that sweet spot, that highest interest rate. And you still have a quarter of your money maturing every single month. Now, if you don't like the idea of T-bills, I get it. But when you keep money in a savings account, that's exactly what you're doing. You're loaning money to the government. And so might as well bypass the middleman, the bank, and keep all that interest for yourself. You are taking on some additional risks. So this is not something to do with your checking account or money that you might need while it's not matured yet. But eliminating the risk of the middleman and getting that extra interest yourself can really help if the situation is appropriate for you. This is not a strategy that I've talked about before because for the longest time, the inflation rate was above the rate that these T-bills were paying. And so if you did this, you were still losing money to inflation. That is no longer the case. But there's a second reason that presents a bull case for bonds right now that we have to look at. And that comes down to how crowded the short trade is on bonds right now, especially treasuries. So to understand what's going on here, I'm going to explain the mechanics of how bonds work and what they are. If you've heard me explain this before, go ahead and skip, chapters are below. I'm going to borrow $100 from you, and you're gonna charge me a 5% interest rate. That means I take $100 from you, and in 1 year, I give you back $105. Once that loan has happened, a bond has been created. That's all a bond is. It's one person loaning money to another person with an interest rate attached. And a treasury is just a government bond. It's somebody loaning dollars to the US government. But just because I borrowed money from you doesn't mean that you have to wait until I can pay you back to get your money back. Because there's other people out there that want to loan money. And so you can simply sell this bond, this contract between us where I'm gonna pay you back $105 in 1 year, you can sell that contract to somebody else. So you sell that $100 bond with a 5% interest rate to somebody else for $100. Now you get your $100 back, and I owe my $105 to the new person now instead of to you. Your total return was 0 because you lent $100 and then you sold that debt for $100. So you got your $100 back and nothing more, nothing less. You walked away with a 0 return. The new person, I will owe them $105 and they will get the 5% return. But what happens if interest rates have changed in between the time I borrow money from you and the time you want to sell that debt to someone else? Let's say interest rates go down from 5% to 4%. If you then go try and sell that debt, you're going to be able to sell it for more than $100 because everybody else out there that wants to loan money, if they loan $100, they're only going to get $104 back. And so the contract that exists between us, I'm going to have to pay $105 when it matures. So you can turn around and sell that contract for $101 because that new person that buys it for $101, they're still going to get $105 back from me. So they're still going to get their $4. Now I know percentage wise that's not exact, but it's close enough, you get the point. But what happens if interest rates have risen in between the time you and I borrow the money and when you want to sell it? If interest rates go up to, let's say, 6%, I'm only going to pay you back $105. So if you need to sell that debt to somebody else to get out of it, you're not going to be able to sell it for $100 because that person is only going to get a 5% return then. They could loan money to somebody else and get a 6% return. So if you want to sell that debt to somebody else, you're only going to be able to sell it for $99. The new person buys that debt for $99 and I repay $105. That's roughly 6% in line with market. You walk away with a loss then because you bought something or you loaned $100 and you only got back $99. Whereas in the first example where you had interest rates go down, you actually made money. You lent out $100 and you got back $101 when you sold it. So you see now how interest rates are inversely correlated to the bond prices. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. This is a chart of the 1-year government treasury, and you can see interest rates have skyrocketed. When the Fed had interest rates very low during 2020 and 2021, they were basically 0%. And when the Fed started to raise interest rates, they've now gotten up to 4.8%. This means that anybody who made a loan at this low, near 0% interest rate, loaned money to the government there, and then saw interest rates spike, you better hope that they were able to hold that to maturity, because if they had to sell that before the 1 year was up, then they took a big hit on that. Now, you know as well as I do that the Federal Reserve raises interest rates in order to deal with inflation, just like they lower interest rates in order to deal with deflation. When 2020 started, they lowered interest rates to incentivize people to take on debt. If they make debt very cheap, everybody gets new debt and uses that to buy stuff like houses and stocks and businesses and cars and boats and employees. Money is cheap, so they're going to get as much of it and they're going to spend as much of it as possible. That's going to stop prices from falling and send prices up. But when prices started going up too much, now they want to put a lid on that, and so they start to raise interest rates. That means all that debt that people accumulated during 2020 and 2021, now people have to start paying that off because they can't afford to just get new debt and use that to pay off the old debt because the interest rate on the new debt is so much higher. So people and businesses have to devote more and more of their income to deleveraging, to getting out of debt, or else they have to devote more of their income to paying the higher interest rates on the new debt. Either way, higher interest rates means less money going through the real economy, putting downward pressure on prices. There's much speculation that the Federal Reserve is going to only do one more rate hike. This is because the CPI peaked in June of 2022 and has been falling consistently ever since. And we know that the Federal Reserve raises rates in order to deal with inflation, and so if they see inflation coming back down to where they want, they'll stop raising rates. We also know that when interest rates go up, that means bond prices fall. So if interest rates are no longer going to be going up, that means bond prices are no longer going to be going down. And bets on bonds going down in price, otherwise known as shorts, are at their most extreme since 2020. That's right, we have the setup for an epic short squeeze on bonds, meaning that all of those players who are net short bonds because of interest rates they've been going up are going to have to get out of that trade, which means buying bonds back to close those shorts. And when all that selling pressure turns to buying pressure, that means bond prices are going to have to go much higher, which in turn will drive interest rates down. So buying a 1 year, a 2 year, or even a 10 year right now could mean that you're locking in a higher interest rate on that debt than you'll be able to get in the near future, because bond prices might be headed higher, which means future interest rates will be headed lower. Now, you always want to make sure that you can hold it to maturity, that you're not buying a bond with the anticipation of selling it before it matures. But in this environment, it's very possible that you could buy a bond for that specific purpose to sell before it matures, simply because we know rates are going to be falling because everybody's going to be buying. And with those higher prices, you could get out at the higher price. That would be a speculative trade, but it's one that's betting against the current consensus, which is a very crowded trade right now. Now, this is a chart of the current treasury yield curve, and you can see that it is severely inverted. An inverted yield curve is always a sign that a recession is coming, and a recession indicates that the Federal Reserve will lower interest rates in the future to take care of it. It also indicates that prices will be dropping, which means inflation won't be around anymore, which means that it's very possible that buying a 1 year, 2 year, or even up to a 7 or 10 year, that your real return across those years will be positive. So there are lots of signs right now that point to a bull market coming for bonds very soon. And even without that, a laddered T-bill strategy may be appropriate for people who have excess dollars in savings that they want fairly liquid and want to earn a little bit of a higher interest rate on it. And it's worth noting that I am not doing this. I've never recommended buying bonds, and I don't buy bonds myself. I don't like to loan money to the government. But I think it's worth noting even for anybody interested in a short-term trade. Do your own research, make your own decisions, and don't take my advice because I'm just some guy on the internet. As always, really appreciate you guys. Thank you so much for watching. Have a great day.